Something unusual is occurring. A warning from Bank of America, a major global financial institution, should be taken seriously. This isn't because the bank is invariably correct, but because historically, when a bank of that scale begins to express significant concerns, a substantial change is about to happen and may already be in progress. This is not sensationalism or an attempt to create alarm. It is an indication linking inflation, the housing market, the dollar's value, and a peculiar financial tendency that is gradually becoming apparent on Wall Street. By the conclusion of this discussion, you will understand precisely why Bank of America's caution pertains to more than just the financial markets. It concerns you. A month ago, Bank of America provided its clients with a report called "The Hard Landing May Already Be Underway." While it is filled with technical charts and economic analysis, one section is particularly noteworthy. The report, almost as an aside, states that American consumers are nearing exhaustion. Essentially, the American economy's primary driver, the spending by consumers that has fueled the world economy for many years, is weakening. Bank of America's analysts, examining substantial credit card information, have found a decrease in spending, a decline in savings to below pre-pandemic levels, and a subtle increase in missed payments on credit cards and car loans across most income ranges. This is not typical, particularly with low unemployment. What is the explanation for this? Consumers are essential to the American economy. Approximately 70% of the United States gross domestic product is comprised of individuals' purchases of necessities, housing, entertainment subscriptions, and even occasionally expensive coffee. In 2020 and 2021, this consumer strength was greatly enhanced. Trillions were distributed as stimulus funds, interest rates were very low, debt was cheap, the stock market performed strongly, and cryptocurrency values doubled. People generally felt prosperous. However, the benefits of this stimulus are now gone, and Bank of America's figures indicate that while the economy continues to function, it is doing so unevenly. The channels of the economic system, credit, savings, and confidence, are becoming obstructed. Ironically, the Federal Reserve's attempt to reduce inflation may in fact be causing the economic slowdown that will lead to falling prices and economic difficulties. Inflation reached over 29% in 2022. The Federal Reserve then raised interest rates from almost zero to over 5%, making mortgages, vehicle loans, and credit cards significantly more expensive. Average Americans are now paying historically high rates, 24% on credit cards, 8% on car loans, and 7% on mortgages. Income increases, however, are only around 4%. This difference is problematic. Consumers continue to spend each month, but are doing so with more and more borrowed money. Bank of America's information reveals that credit card debts have reached a record high this quarter, while savings accounts have diminished. The economy is continuing at speed, despite the fact that resources are dwindling and the bank predicts a downturn. Despite the current optimistic commentary in the financial markets, with talk of a soft landing, disinflation, recovery, and soon-to-be reduced interest rates, the outlook appears positive. The stock market is increasing and the economy looks stable. Bank of America, however, disagrees. They highlight what they describe as the illusion of resilience. Company profits are up, but not as a result of increased sales. Instead, they are up because companies are decreasing costs, using more automation, and quietly reducing their workforce prior to the start of a recession. Consumers are continuing to support the economy using savings from the previous year. This isn't genuine improvement, it's momentum, much like a stone as it falls towards the ground. Are we starting to understand the situation? The elements that preceded past economic downturns, difficulties with debt, excessive optimism, declining income, and increasing risk with available funds, are all reappearing, subtly, beyond the main news stories. Therefore, I would like your opinion. Do you believe Bank of America's caution is another unfounded alert, or do you sense a significant underlying change occurring? Please share your views in the comments. I will read all responses to these in-depth analyses. And if you wish to be informed about what could be the most substantial macroeconomic change of the decade, please be sure to subscribe. This is very likely to be the first of several warnings. This warning extends beyond the United States. A reduction in spending by American consumers impacts not just domestic profits, but also global supply chains, commodity costs, and developing economies. Bank of America has identified a slowdown extending into Europe, where manufacturing is already shrinking, and China, where the property market bubble is slowly deflating. The three largest economies globally, the US, Europe, and China, are all performing poorly. In 2008, the issue was poor lending standards. In 2020, a sudden cessation of activity. By 2026, it may be exhausted consumers alongside a financial system that has been stressed by many years of low interest rates. The situation has a certain irony. The economy has been reliant on cheap money for a long time, and now that it's no longer readily available, many are acting as though all is well. It's as though a marathon runner, suddenly lacking enough oxygen, continues to run, even smiling for the cameras, yet is on the verge of collapsing. The indications are all available, in the figures, in how people are behaving, in the restrained warnings from banks which rarely reveal the full extent of the problem until it's too late. This is more than just a prediction for the next 3 months, because if Bank of America is correct, the next economic period won't resemble previous recessions. It will be more like a gradual decline than an abrupt collapse. A prolonged period where expansion feels insincere, earnings don't increase as much as the cost of living, and the value of investments remains stable, but with considerable fluctuations from even minor disruptions. When you add to that international political issues, massive government debt, and trials with digital currencies, an analyst's description of the twilight zone of finance is remarkably accurate. A state of neither expansion nor failure, simply drifting. And that drifting erodes trust. When trust is lost, everything deteriorates. Bank of America's warning isn't intended to be frightening, but to facilitate preparation. However, how does one prepare for a slowdown that appears to be normal until it isn't? That is the issue the financial markets will have to resolve. The difficult truth is, there's no announcement before a downturn commences. Often, those with the best understanding of the situation offer their warnings in a subtle way. In documents in portable document format, as small notes, in sections many people overlook. Perhaps the warning is already present. Perhaps the next stage of the economy has already begun. The remaining issue is whether investors are willing to acknowledge that fact.